Hi there. In this video, we explain CIS payment and deduction statements and why they are essential for contractors and subcontractors in 2026.
Imagine your firm experiences a quiet month. No new contracts are signed, and zero payments are made to subcontractors. The site is entirely inactive. Since a deregulation effort in 2015, the prevailing assumption across the industry has been that a complete lack of subcontractor payments means there is no requirement to file a return with HMRC. This animation illustrates what happens when an automated HMRC audit catches that assumption 12 months later. The initial £100 late filing fee automatically escalates, compounding into a severe £3,000 penalty, despite the company spending exactly £0 on subcontracted labor. The April 2026 reconfiguration of the Construction Industry Scheme, or CIS, reverses the 2015 deregulation. Under the updated framework, HMRC's automated systems actively penalize silence. ProTax Accountant is a UK accounting firm dedicated to navigating these exact compliance shifts, helping businesses protect their cash flow from automated tax penalties. Central to the entire 2026 framework is the payment and deduction statement. It serves as the primary digital anchor connecting subcontractor deductions, the reinstated mandatory nil returns, and the Making Tax Digital initiative. Treating the 2026 CIS regulations as a standard bookkeeping chore is a direct route to a guaranteed £3,000 liability trap. This diagram shows a standard payment and deduction statement. Contractors must issue this to subcontractors within 14 days of the tax month's end, by the 19th. It begins with top-level identification fields, the contractor's unique taxpayer reference and subcontractor verification number, required to map transactions across HMRC databases. Below this, the financial breakdown is itemized into columns: gross pay, materials, and deduction amount. This document is the legal proof of advance payment. It verifies the tax has been deducted at the source and credited toward the subcontractor's annual income tax and national insurance liabilities. This visual compares the three specific deduction tiers determined by HMRC's verification. Subcontractors registered for CIS see a 20% deduction. Unregistered subcontractors are penalized with a 30% deduction. Those who pass HMRC's rigorous compliance checks achieve gross payment status, resulting in a 0% deduction. Without a precisely formulated statement, a subcontractor lacks the legal proof required to claim their advance tax payments, blinding both their own accounting and HMRC's digital systems. Consider an SME contractor processing a standard £12,500 invoice from a registered subcontractor. Granular record-keeping is an absolute necessity here. The contractor must demand receipts and exact breakdowns from the subcontractor before authorizing any transfer of funds. Looking at this block diagram, we see the strict separation required by CIS. The £12,500 invoice is split into a £10,000 labor element and a £2,500 materials cost. The 20% CIS deduction applies exclusively to labor. £2,000 is carved out of the labor block and held back for HMRC. The final payout mechanics are precise. The subcontractor receives the £2,500 for materials, plus the remaining £8,000 for labor, totaling a net payout of £10,500. The contractor remits the £2,000 directly to the government. Applying deductions to material costs strips subcontractors of their operating capital, creating immediate mathematical noncompliance and severe cash flow disruption. The CIS tax month operates on a strict boundary. It runs exactly from the 6th of one month to the 5th of the following month. Many companies mistakenly conflate a lack of financial activity with a lack of reporting obligations, assuming a silent month requires no administrative action. The April 2026 policy reversal eliminates this assumption. Following a spike in penalty-related debt from the 2015 deregulation, HMRC is reinstating the mandatory nil return for all mainstream contractors. This flowchart dictates the new operational requirement. If subcontractor spending is zero, a contractor must either file a CIS 300 nil return by the 19th or submit an inactivity request 14 days prior to the month's start. Penalties for missing this step are fully automated. They are issued by HMRC's AI systems without manual human review, and they are unappealable. The penalty ladder escalates rapidly. A missed return triggers a £100 fine on day one, £200 after 2 months, and tax-geared penalties of up to £3,000 or 100% of the theoretical liability at the 12-month mark. Proactive reporting of inactivity is a contractor's only defense against this automated financial drain. Starting in April 2026, the regulatory burden shifts heavily onto subcontractors as well. The traditional single annual self-assessment tax return is being replaced. Under the Making Tax Digital for Income Tax initiative, subcontractors must submit 4 mandatory quarterly digital updates. As this diagram illustrates, the data housed on the payment and deduction statement must now feed directly and continuously into the subcontractor's MTD-compliant accounting software. This quarterly reporting requirement applies to any sole trader whose qualifying income exceeds £50,000. Crucially, this threshold is calculated on gross income before any CIS deductions are made by the contractor. Subcontractors now depend on the PDS as a continuous, real-time data feed required for their quarterly compliance survival. Subcontractors often operate under the dangerous assumption that gross payment status, once achieved, is a permanent and untouchable classification. The April 2026 reforms grant HMRC sweeping anti-fraud powers. They introduce a strict liability standard known as the knew or should have known test. This network graph demonstrates the risk of supply chain contamination. If a fraudulent actor enters the chain, liability travels upward. If HMRC determines the main contractor should have known about the fraud, the entire network is compromised. The punitive action is immediate. HMRC instantly revokes gross payment status and imposes a 5-year ban. Additionally, HMRC applies a crippling penalty equal to 30% of the lost tax from the fraudulent transaction. The loss of gross payment status forces an automatic 20% withholding on all incoming revenue for that contractor. The business loses 1/5 of its operating capital overnight before it can even pay its own suppliers. Under the new fraud standard, rigorous supply chain due diligence and exact documentation are matters of corporate survival. The payment and deduction statement is the digital engine powering tax compliance for the entire construction sector, starting in 2026. This summary matrix outlines the non-negotiables: accuracy in reporting, strict monthly filing discipline through mandatory nil returns, and rigorous supply chain verification. Please note, this video is for educational purposes only. Tax laws are complex, and your specific circumstances will dictate your individual tax liabilities. To protect your cash flow, secure your gross payment status, and ensure your reporting systems are fully compliant, you need expert oversight. Contact Pro Tax Accountant today to implement a defense strategy tailored to the volatile 2026 regulatory landscape. Subscribe to the Pro Tax Accountant channel to maintain a strategic, informed advantage over shifting UK tax compliance.